What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. If you're watching on Twitter, please give us a retweet. And if you're watching on YouTube, hit that subscribe button so you don't miss an episode of the Futures Radio Show podcast. Today we have Larry Tentarelli on the show. Larry's been on the show a bunch of times before in the past. Learned a lot from Larry in the past, so I'm excited to have him on the show today to speak with you guys. And Larry's going to be sharing with us his strategy for taking advantage of markets that are trending. We're going to talk to him about how he identifies what a trend is. We always talk about trading with a trend, but how do you actually identify what a trend is? I think it's a lot more than just looking at a chart and saying, oh yeah, this is going up or down. You have to identify when that trend is broken and what things you put into place for that. We're going to talk about the mental aspect of trading, dealing with winners and losers. I want to talk with Larry about transitioning from being in the full-time workforce to becoming a full-time trader, how he went about that transition, and what eventually gave him the green light to say, I'm no longer going to be working anymore. I'm going to be focusing solely on trading. And then we're at the end of the show, we're going to go to the charts, see what trades Larry is currently in, see what he sees about the markets, and we will be taking your questions live. So be sure to drop your questions in the YouTube chat. So if you're watching on Twitter, hop over to YouTube to drop your questions there. Before we get Larry on the line, I want to remind all of you about micro treasury futures. I don't know about you, but I am actively looking at my charts to see what yields are doing lately. I think that the yields are going to be big movers between now into next year and even well beyond. So be sure to pull up these symbols so you know what the yields are trading. 2YY, 5YY, 10Y, and 30Y. To learn more about micro treasury yield futures, go to cmegroup.com. Futures Radio Show podcast is sponsored by CME Group, Trading Technologies, TradeStation, and FTSE Russell. The Russell 2000 is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 future symbol RTY and micro E-Mini Russell 2000 future symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. LT, what's up, my friend?
Anthony, how are you? Good to see you.
Great to see you. It's been a little while since we've had you on the show. How's everything been going for you?
Been going great. Everything's good. Markets have been pretty good. I can't complain.
Good. You know, one of the things that we talked about in previous podcasts with you, and I want to talk about this today because so many people ask me this question. How do you know, Anthony, when to stop working and make that full transition from being in the workforce and trading, building your strategy as a trader to eventually saying, this is it, I am now ready to stop working and focus full-time on trading?
That's a great question. And I get that question probably once a week. Friends, family members on social media. And I think it really comes down to everybody's mindset. So I'm a big believer in having, multiple streams of income wherever you can get that. Oh, excuse me, the phone went off. Having, multiple streams of income wherever they can come from. I think a trader needs to be consistently profitable for probably 3, 4, 5 years at least through a variety of market cycles before they make that move. Because, the past year and a half hasn't really been symbolic of what the markets usually do. So we got QE March of 2020. And since then, we've had the Fed backstop. And I don't want to say things have been easier because they haven't been easy. They're never easy. But there's been a lot of really big moves that I think have juiced people's returns that I don't know that you get that in a regular market environment. So if I had just been profitable for the past year, I don't know that I'd want to quit my full-time job and say, okay, I'm going to trade for forever. But I think it comes down to, realistic expectations. If somebody has a trading account of, a couple 100,000, it might be a little bit easier to make that transition than if they've got a $20,000 account and they think that they can make, 80 or 100 grand a year on a $20,000 account. So I think it's something that, everybody's different, but I think it really comes down to having realistic expectations and having enough of a background to feel comfortable with it.
I love that answer. First, you said 3 to 5 years. I was on the trading floor surrounded by traders making millions of dollars. I worked for the first 3 years because I wasn't making any money. And
right.
I don't know why people really, they struggle with the fact that they actually have to work and trade. It's like they want to be the full-time trader so bad that I think
Right.
it's a pride thing. It's an ego thing where they're just like, look I could just go and do this. But yet I think that puts so much pressure on you that you distort your ability to really learn. And a couple other things you mentioned, I think, are so true. Obviously, expectations. I actually just did a video on this with Develop Your Edge this past week. I got a ton of comments on it. And I think that so many new traders, their expectations are way too high. I mean,
Right.
I think it was definitely a little bit different 20 years ago when we both started. A lot of people I knew started with small amounts of money and were able to, be able to turn those into larger amounts.
Sure.
And I think expenses were a lot less then. There's just a lot of different factors. I think markers were a little bit different than they are now. And then the other thing, I think this is so important. This is kind of where I want to go next, is that this type of market, especially a lot of the stock traders I know over the last couple of years, bad habits have been rewarded, Larry.
Yeah.
In a market that keeps going up, you feel that this sense of comfortability of thinking that, look, all I have to do is buy the dip or whatever it is. And the sense of comfort is built, and it creates false expectations. And when you said you have to go through a couple of market cycles, to me, that's the best advice, because until you see a time where you can't make money and how do you react to that, I don't think you really know who you are as a trader to be able to leave a job or not have to work to go full time.
You make some good points. And what I think it comes down to is if you're trading full time and you have a full time job, you have this mindset, I think, that even if trading, if you go through a rough week or a rough month or a rough quarter or whatever it is, you know that you have your employment income coming in. So I think you have that little bit of a mental backstop. And I think once you cut that safety net and you say, okay, boss, I'm done. I'm going to work for myself. It's important, the first day you fire up the computer and you realize, okay, I don't have that safety net anymore. It's a totally different mindset whatsoever. So I think that before people give up, good jobs with benefits and stuff like that, they should really push it as long as they can till they have a really big, cash cushion. They can get through a bad quarter, a bad couple months, whatever it is. But I think it's something, it took me a long time. So I decided in 2003 that I wanted to work for myself and be a full-time trader. But I didn't really make that full move. I put it off for like 17 years. I put it because I was making good money. And I said, okay. And I'm not a very active trader. So I don't day trade. I don't swing trade, things like that. So I'm more of a position trader and a trend follower. So, I mean, realistically, if I take, one new position a week, that might be my average. So I don't know that I need to sit in front of a screen for 40 hours, to take one position a week. So I think everyone's different, but I would say, put it off as long as you can, because once you cut the cord, you want to be sure you've got a good foundation and you don't put undue pressure on yourself.
Exactly. Traders, don't let ego get in the way of reality. Be honest with yourself, and it will really be beneficial to you getting to that point of being able to be on your own. You say that you're more of a position trader, a trend follower. What are the key things you look at to identify a trend for you to step into a market?
Key things I look for, obviously, number one is price. So the basic definition of an uptrend: higher highs, higher lows. And we'll take a look at some charts, whenever you tell me to fire up the charts. Also, I use moving averages quite a bit. So I like to see rising moving averages. So if I see the stock higher highs, higher lows, rising moving averages, then that tells me from my time frame that's an uptrend. And then I want to gauge the strength of the trend and see if it's something that I want to get into or not. But very simple: higher highs, higher lows, rising moving averages. To me, that's an uptrend.
As a trend follower, what is the time frame you're looking at mostly on the charts?
So I trade off of daily charts I do take a look at the weekly charts for some confirmation as far as longer term breakouts and what have you. But my average holding period, I've got basically two targets. I look for positions that I believe within 3 to 6 months, I can get 25 to 50% out of that position. And then 6 to 12 months, I'm looking to get 50 to 100%. So if I get into a position and it starts to work, I have no problem holding it, 3, 6 months or longer. If I get into a position and it's lagging or not working, I might cut it after a couple of weeks. So it's really based on what the trade does.
What moving averages are you using?
So I look at 4, but I use 3 primarily. So the 20-day, the 50-day, and the 200-day. Those are my 3 key moving averages. So when I do my screens, the first place I start is stocks that are trading over the 50-day and the 200-day at the same time. And then I filter the 20-day in because I found that in the strongest uptrends, the 20-day moving average can often provide a lot of support. But those are the 3, but I try to stay above a rising 50-day.
Why those 3?
Because for my time frame, they work the best. So the 200-day, basically the way that I got started with trend following and position trading. So I read a lot of books over time, but I read a book, Trader Vic, by Victor Sperandio, and I think we all know who Trader Vic is. And he wrote a book 20 years ago, and he was a big Wall Street trader back in the 70s and the 80s. And he did an analysis that based on the Dow Jones, if you just bought and sold the Dow Jones Industrials based on a 200-day entry or exit signal, it did like 18% over 70 years. Now, obviously, that was back, in the 70s and 80s. But what I wanted to do, I wanted to develop some type of a technical system where I could just look at a chart and say, okay, I want to be long. I got to turn this off. I want to be long here, right? I'm not good with technology. I should be, but I want to be long here and get out here, because in the early years, I lost a lot of money in the market. So I started in 98 and I made a lot of money for 2 years, and then I lost it a lot faster over 2 years. And after I got just blown out, right, in positions like JDS Uniphase, Nortel Networks, and I bought everything on the way up. Then it started to go down. And I'm like, oh, you got to buy the dip. You got to buy the dip. I kept buying, and the stock started going to zero. So after I took my beating, I said, okay, where did I go wrong? So I started to study charts much more. And what I wanted to do is just look for some type of a signal that would say, okay, I bought Cisco at 70 and today it's 20. Where did I go wrong? So I started to come across moving averages, and that's how I settled number 1 on the 200-day is like my core long-term trend filter. If the stock is below the 200-day moving average, I rarely take a look at it whatsoever, other than to put it like on a long-term watch list.
I guess a lot of people would say, and I would say this even myself, is when you look at a strategy, just a 20, 50, and 200-day moving average, and I'm all about simplicity, don't get me wrong. But I look to that and say, is there any edge there? Explain to me how there is edge by using something this simple.
Well, that's the edge. So the edge is number 1, the simplicity, but number 2, the consistency. Because here's what happens. If I trade, let's say we trade chart patterns, I can pull up a chart, and if I'm bullish on a stock, I can probably find a bullish chart pattern. And if you're bearish on the same stock, you can probably look at the same chart, and I could say, hey, Anthony, I see an inverse head and shoulders in this chart. And you might say, well, I see a double top, whatever rollover. So what I found is that I don't want to be subjective. And I found that when people look at chart patterns, they tend to if you're bullish, you can find all the, look at a chart and find all the reasons to be bullish, and we're on Twitter all the time, you and I, right? So triple Q's been going up for the past year and a half. But every day I see a post with, the negative divergence or, the XYZ, rollover. And, even though triple Q is going up because the 4-second moving average, diverted, it's going down. And really all that is that guy's just bearish. So he's looking on the chart to try to find something to confirm his bearish bias or a bullish, bulls are the same way. So what I found with moving averages, when I started to study how to automate my trading, and my trading is not automated, but I wanted to study and find a rules-based way because I used to overtrade really, really bad. And I wanted to find a way where I could just develop some rules and say, okay, if, one moving average crosses the other, I buy. So I started to study CTAs, a lot of big hedge funds. And I came across a research report and they talked about the best signals that CTAs used. And one of them was pure moving average crossovers. When the 20-day crossed the 120-day, they would buy. When it crossed down, they would sell. Some of them just bought new highs, or 50-day breakouts. So basically what I look for is something that I could do consistently. And here's what I can tell you. If you work at something long enough in trading and you're consistent with it, I think you're going to be profitable. So I trade moving averages to a good degree. Some people trade Fibonacci, and I'm not a big fan of Fibonacci or, any of that. But there are some people, if you've been doing it for 5, 10, 15 years, and that's all you do, you're probably going to get to be pretty good at it. So my edge is my simplicity and my consistency.
I love that answer. And something you said, I think, is so important. If I pulled a chart up here and we had everybody that's watching this look at that chart, you probably have, let's just say there's 100 people looking at that chart. You probably would have, I wouldn't go as far as say as 100 different ideas about what that chart would do, but it would be up there.
Yeah.
And what people don't recognize, and I've talked a lot about this, is their underlying bias going into looking at the charts. And what you're doing with something as simple as this is creating consistency of proof through the moving averages. Because I too myself, I don't care how long I've been doing this, when I all of a sudden see a head and shoulders pattern, and it doesn't matter what time frame it is, in my mind, if I'm a little bullish or bearish that market, I see how that next move could be. Right? Because in your mind, this is you're trying to think about what the next part of that puzzle is.
Right.
With the moving averages, and I think this is where people go wrong by criticizing simplicity with any sort of strategy. And a lot of times with moving averages is that they're just proving to you what's happening. They're not lying to you. They're looking you in the face and saying, we're holding above the 20. We're holding above the 50. We're holding above the 200.
That's exactly right.
You can be consistent with your execution with it, and execution comes into play here now. You get better at executing it. So I guess the next part of what I'm going to ask you is, how are you identifying when to get in? Is it touches of the 50-day moving averages? Is it getting above the 20? What qualifies that as an entry? And also talk to us about how you're determining an exit and stops.
Okay, good question. So the first thing, I always keep a watch list. So I focus, what I found over time is the more that I focus my attention, the better I do. So what I mean by this is right now there's, I think in the FinViz database, 8,000 stocks, right? So the first thing I do is I really narrow my universe down to large cap stocks, 10 billion and higher. So that's 930 some odd stocks. Then what I do is I eliminate utilities, REITs, and consumer staples. There's 11 S&P sectors. I eliminate those 3 because there's just not enough volatility in those stocks for me to make enough money for my time frame. So then I eliminate any stock that's under the 200-day moving average. So right now that takes me down to like 500 stocks. And then I'll continue to narrow it down to where I'll have at any one time, I'll have a watch list of maybe 25 stocks that I keep on my screen all day long, right, in a variety of sectors. And then what I'm looking for is I'm looking for one of 2 things. If I get a breakout from a base to a new high, for me, that's a rock solid buy signal. So it recently happened in Tesla, happened in Applied Materials. We'll take a look at a bunch of charts. So I took a position today in a stock. I've been watching it for like 2 weeks. It broke out to a new high. I bought the stock. So that's my best signal right there. The second thing is if I miss a stock, so we can't get into everything. So if I miss it, like I missed Roblox, right? I've got NVIDIA, Tesla, Affirm, all that stuff, but I didn't get Roblox. So Roblox is broken out without me right now. So now what I've got to do is I can either go after it, try to chase it, and it might go straight up, but I'm not going to do that. What I have to do now is if I want to get a position in Roblox is I just need to wait and see it pull back either to 20-day moving average, hopefully not further. But so that's what I look for. I look for either a pure breakout to a new high, number one, a pullback into the 20-day or the 50-day, number two.
One of the common pitfalls I see, especially with stock traders when you are in this bull market, is FOMO. We talk about it all the time on social media.
Yeah.
How do you deal with that? How do you deal with not chasing Roblox because it fits into your criteria and it's taking off? How do you deal with that?
It's taken a lot of time. So it's not easy. And I think the way that I'm able to deal with it is a couple of reasons. Is number one, I used to chase a lot of stocks. And then I lost a lot of money because I would chase the stock, it would break out. I'd be like, okay, it's going to go up forever. Then it would go down 2 points and I'd sell out of it. So what I want to do is I want to avoid getting whipsawed. And I think the biggest way to avoid FOMO is here's what I know. I know that the way that I trade, right, and the stocks that I trade, I know that I'm going to hit home runs. I've got Tesla. I don't know what I'm up 60 or 70%, something like that. And NVIDIA's up like 100%. I've got Affirm. So here's what I know. I know that I'm going to hit home runs on a consistent basis. So even though I might have missed Roblox right now, I know that even if I don't buy Roblox today, tomorrow I'm going to get, or maybe not tomorrow, maybe Friday, I'm going to find another Roblox that's setting up or another NVIDIA or another AMD. So basically what I do is I've got a process that I follow. If I can get an entry signal inside that process, then I'm going to take a look at it. But if I just miss it like Roblox, well, guess what? There's going to be other Robloxes. There's Unity's been big, AMD, NVIDIA. There's, off the top of my head, there's probably 100 or 150 large caps that are up 50% plus year to date. So it's like a bus. If I miss this bus, Roblox is not the only stock that's ever going to go up. You see what I mean? So instead of chasing this one, I missed it. It happens. Nobody gets into everything. I'll just wait. If it comes down, I'll take a look at it. And sooner or later, they all come down. So, even Tesla, they took that down. NVIDIA, they're taking down C today. So, I know that if I don't get this one, I'm going to get another one.
Something interesting you said was, that you'll get a home run with one of these stocks. And I noticed some that may sound like, well, how do you know that? How do you know that's going to happen? And is that just because in your experience, by being a trend follower, if you're in one of these and you have a handful of these stocks, one of them is most likely to have that big run? It's been consistent enough in your findings that that's what happens.
Oh yeah, and it's usually a lot more than one. So what I do, I go into high beta stuff. So like when I get into a stock, like I'm not going to buy, Procter and Gamble stock. What's on my radar screen now, I've got Freeport McMoRan, which I just bought. And I know from experience, that's a copper miner. I've got copper stocks, I've got steel stocks, I've got energy stocks, and these stocks can easily go 20, 30, 40, 50%. They've done it in the past consistently in a short period of time. I've got Tesla, I've got some, so I go into the high octane stocks for the most part. I've got Bank of America, I've got some, more subdued stocks because I split it up. But when these stocks start to break out, there is no telling how far they can go. But I know that they can turn into home runs because, number one, I've had, hundreds of them in the past, but I don't micromanage my positions. So once I get into a stock and it starts to work, I'm not worried about the next 2 or 3 or 5% pullback. As long as it stays in that longer term uptrend, I'm going to let it work. So the home runs don't happen overnight. If I can make 50% in a position in 6 months, to me, that's a really good, it's a really good trade. But it's still 6 months. I'm not thinking I can make 50% in 6 days.
Got it. And another thing I'm curious about is allocation, because is there any setups that you'll allocate more to than others? Because to me, we've talked about consistency with the looks. So a lot of them are going to be pretty much the same setup, right? Essentially, that's what you're looking at. And are you deciding sometimes to trade bigger in sometimes to trade smaller? How much cash are you always leaving on the sidelines in case a Roblox pulls back? How are you allocating that?
Yeah, those are good questions. So in higher volatility stocks, I might take a slightly smaller position because I'm going to give it a little bit more of a stop to work with. But of the 3 key signals that I look at, so if I get something that's coming over the 200-day moving average, to me, that's a little bit of a weaker chart. So right now I think I've got 18 open positions, right? Which sounds like a lot to a lot of people, but for, my time frame, that's about normal. But of stocks that I bought that are just now starting to come over the 200-day moving average, I think it's maybe, 2 or 3. Whereas the most of my positions are going to be already in nice established uptrends that are breaking out. So I would say I probably devote, 3/4 of my positions to confirmed uptrends. And then maybe, 20% or so to stocks that are, were in downtrends and now they're trying to turn back up. So those charts to me aren't as strong. So I'm not going to have as many of those.
Got it. Okay. What I want to do is I want to have you pull up your charts now. And while Larry's doing that, everybody, we're going to take a quick break. And I want you to start putting your questions in the comments area. And Larry, if it's okay with you, we're going to have people ask some questions about some markets, maybe chart and look at and tell us what you think.
Sure. Yeah. Maybe what we'll do is I'll run through my charts real quick and then we'll take a look at some more.
Got it. Sounds great. Okay. All right, everybody. Start dropping your questions in chat, and we'll be back in 30 seconds.
Replace your exchange with TradeStation Crypto. Dealing with multiple exchanges is complicated, and it takes time, except with TradeStation Crypto. Because we are not an exchange. We are a broker. You have access to multiple pools of liquidity. All in one platform, in one account, one way. Trade crypto your way. Plus, earn interest on your eligible cryptocurrencies. Get started in one click.
Trade the global markets with Trading Technologies. TT is the world's fastest commercially available futures trading platform, now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. Learn more at tradingtechnologies.com. All right, everybody. Starts with LT. LT, what are we looking at?
Am I back with you?
You're back with me.
Okay, so what I'll do is I'll run through some charts quickly, maybe just a couple minutes, and this will just give you a brief idea of trends that I look for and trends that I avoid. And I brought up a lot of common stocks that that your listeners probably have positions in. So long story short, if we just look at the indices, what tells me this is an uptrend, NASDAQ 100. First thing, we see the 200-day moving average. That's rising. It's been rising for a while. Then we just take a look at the overall trend. Now, it's been choppy, but you've got higher high, consistently higher highs, and we're over rising moving averages. Now, things did get choppy here in September by far. So I had a little bit more cash going into this. I did make some pullback buys, but for me, this is still a longer term uptrend. But when it lost the 50-day, I got a little more concerned. And when it lost the 100-day, I got more concerned. So these are two key checkpoints for me. But overall, that's in a nice longer term uptrend. Last week, there was a little bit of a fake out with the CPI scare. But if you take a look at it, and I shared this with my members, the NASDAQ 100 hadn't even broke the 20-day moving average. So, you know, a little bit of a shakeout, held the 20-day. So if I'm a trader using the 20-day, it's very simple. Is the index above the 20-day or is it below the 20-day? That's it. There's no subjectivity. S&P 500 is the same thing. So we'll take a look at some charts. So treasury yields, here's what I can tell you. I do think, and I've thought this for a while now, whatever happens in the bond market is going to determine what happens in the stock market. And bond yields are trending higher. We can see that the 200-day moving average has been rising the whole time. But you can see, just if you look at the overall trend, starting to trend higher. If bond yields start to break out significantly for whatever reason, they're talking about the Fed and, is Powell going to run the Fed, or someone else? If bond yields break out, then I think it's going to put some pressure on some of these higher growth, higher valuation stocks. And if bond yields start to break down or even stay where they're at, I think that the tech stocks and the growth stocks can do fine. But just to take a look, so Apple just starting to break out right now. So if we just talk about moving averages, we can see Apple right now is over all four. And then if we just take a look at pure price levels, we can see that today it started to break out. 152 to 154 is the level that I shared, that I said, if Apple can break through that, then I think it could go further to the upside. We'll take a look at one more. So we'll talk about FOMO for a second. So a firm, I started to look at a firm somewhere in here when it came over the 100-day moving average. So I looked at it for a little bit. I didn't do anything because I wanted to see it get a little bit stronger over 75, and I missed it. And here's where I think they announced their Amazon partnership. So I'm sitting looking at the chart right here saying, this stock is starting to look pretty good. If it goes over 75, I want to get a position. And then while I'm sitting here, it's up 50% overnight. So now I could have done one or two things. I could have gotten FOMO, chased it, bought it here. I probably would have stopped myself out. So I waited here, and then they had earnings, and I missed it again. So now I started looking at it here. It's all the way up here, and I still don't have a position while the stock doubled. But then they pulled it back here over the 20-day moving average, and I started my position. I don't know if you can see that black bar, but that's where I started my position. So when we talk about avoiding FOMO, I mean, it was on my screen right here. I said, this looks like a good stock. And then the next day, it's 50% higher. And then, you feel stupid. But it pulled back. It broke out with that. So in this case, I basically just had to wait until the stock pulled back to a level where I felt like I could get a good entry point for my time frame. But that was a perfect stock to talk about, avoiding FOMO. Applied Materials. So I bought this about 2 weeks ago, and my buy signal here was very simple. This bar right here, when Applied Materials broke out to a new all-time high, is when I bought the stock. So like I say, as simple as it gets, new all-time high, I bought the stock. Starting to drift higher, it's over all the MAs. But really for me, new all-time highs, especially when you come out of a wide price base like that, that's the most purest, cleanest signal that you can get.
To me, that almost looks exactly like the Russell 2000 chart to me. I know because I've been in a swing position long. Yeah, because you pull let's maybe we can go to the Russell. I'm just curious to see what that looks like.
It looks exactly, and I don't know if they both broke out together. It looks exactly.
Yeah, look at that. Yeah.
And I don't know if they both broke out because of, the market is perceiving that cyclical stocks, because, the Russell's more cyclical with the small caps, and Applied Materials is a little more cyclical because they're really based on the semiconductor cycle. So yeah, I mean, they're very identical charts.
Got it. Yeah. And, does what the companies do. I mean, kind of a Mark Minervini or a moment. Remember when he was asked that question? Well, what does Upstart do, or whatever it
Sure.
was? And I kind of chuckled at that because, to me, I have definitely bought some stocks that I don't know exactly what they do. I mean, I just admit it. I mean, whatever, it is what it is. But for you, as somebody who focuses on this, does that matter? Do you know what every one of these companies does?
Yeah, it does. It does.
Okay.
And the reason why that it does so, obviously I've got a website, I've got members that belong to it. But what happens is a lot of people, they want to know what I'm buying. So it's important that when I put money into a position, now here's what I'll say. From a pure technical perspective, it doesn't matter whatsoever. If you're just trading breakouts, if XYZ breaks out and you look at the chart and say that's a breakout, then it doesn't matter. But to me, I do have a filter. So, I want to know what a company does. So I don't have Rivian. I don't have Lucid. I don't buy stocks that don't have any revenues, and I think I take some aggressive stuff, Tesla and Affirm. But, for me, a company, and these stocks are doing great, and I'm not negative on those stocks whatsoever. And I've covered Lucid for my website for about 8 weeks now. But just to me, I do like to see, a real company. I like to see some good in these growth stocks. I like to see good sales growth. Most of them, a lot of them don't have earnings. But yeah, I do pay attention to what they do, because also the industry that they're in tells me a lot about what I can expect to get out of the stock. So if a consumer, let's say a utility stock breaks out, to me, I'm just not going to buy a utility stock.
Yeah. Now, somebody sent me a private message. They go, Anthony, which stocks have you bought that you don't know exactly what they do? And one of them that I bought as of late, and everyone knows I don't do a ton of stock trading. And a lot of times the stuff that I'm invested in the stocks is going to be the indexes, Apple, stuff like that. But I bought that DWAC. Remember that? The
SPAC, right?
The SPAC, yeah. I bought a couple of SPACs in the past too.
Yeah.
I can't remember which one's up, but I heard that was going to be the Trump social media one, and I looked at that. And as it was taking off, I just went to my longer term stuff and I just bought some because I'm like, I didn't know exactly what they did. I knew that was tied to it. I saw the news, caught it. I mean, it's one of those things I'm just putting away, but it's kind of almost in a way, like even like the way that you even have traded crypto. I do that with some of these stocks where if I hear something about it, or I look at it, a lot of times I'll go to social media and I'll say, oh, what are these people talking about? And I see, some companies, and I'll put just small little increments into a longer term accounts and say, I kind of throw it at it. I mean, I'm not recommending for people to do that, but I admit at least that I still do that sometimes. I mean, because I don't know exactly what DWAC does. I heard the news and I'm like, you know what, let me do it. So, I mean,
it goes up.
Yeah.
It goes up.
So we're starting to get some questions in here.
Yeah, we'll jump into the questions.
And this is a good one. And Ronnie's asking, on the pullback screener, other than filtering for stocks over 50-day SMA and 200 SMA, what is the key filter that is needed to screen for actionable pullback buys?
Well, the first thing, here's what I do. So I don't just screen through 900 random stocks all day. So at any given time, I've got on my watch list, let's say right now I'm looking at Roblox, if that pulls back, which it might not. I'm looking at Unity software, maybe Cloudflare. So when I look for these pullback buys, I've already got a narrow list of stocks that I've determined are technical leaders, and I might have missed them. So I don't just, fire up my computer every day and scan through, the 900 stocks. I already have a focus list, and I'll sit there and wait. So when I took Affirm, so I had Affirm, I started to look at it here. So I had to wait about a month until Affirm gave me a pullback over this 20-day. But I already knew that I wanted to get a position in Affirm. So for me, it was just a matter of waiting until I saw what I needed to see on the chart. So it's the same thing with Unity and with Roblox or, Qualcomm. I've got Qualcomm on my screen too. I'll follow those stocks. And in this case, it took me a month until I got my position. But, since then it's up, I don't know, 40% or something like that. So for me, it's, I already know what I'm looking at. Relative strength helps, but I know right now off the top of my head, the 10 or 15 strongest stocks that I don't own that I would like to get a position in.
Got it. And I thought that was obviously a great question, and thank you for answering that. And Don Diego Dollar is asking a question that I was actually going to follow up and really ask you about. And we talked about it a little bit before we got into the charts, but he's like, what are you just talking about? What are you just selling? Rules to a strategy? What is your stop loss? And when do you take profits? And when do you get out of a position? So maybe let's just use one of your previous examples of something that you've taken profit in or something that you've gotten stopped out of, so we can get a visual representation of what that is. So if you're listening to this on audio only, everybody, you got to go over to YouTube.
Yeah, we'll take a look at a couple. So we'll start with NVIDIA. So I've got a good sized position in NVIDIA. Basically, what I do and what I set up for the website is I want to have a system that people can follow along pretty simply, and they have a general expectation, of what to look for. So the rule that I set up is once I get into a position, if it goes up 20%, as soon as it hits plus 20%, I'm going to evaluate the stock, and I might take 20 to 25% out of it. So I'll give you an example, something that I just sold on Monday. So Snowflake, I got into Snowflake somewhere around here, full size position. And on Monday, I think it was, which is this bar, I was up 24% in the position. So I just sold 25% of the stock, and I moved my stop up to break even, which is 315 and change. So here's why I do that. Number one, the market moves fast, and we don't know, we can look at charts like Facebook or Snapchat that were, they were up here and then they were down here, and I had Facebook up here. I didn't take any money out of it because it looked like it was going to go much higher, and then they took it down. So I had to relook at, refocus on my rules. So once it hits plus 20%, then I'll take a look at scaling back, maybe 20 to 25% of the position. Because here's the thing, I don't want to sell out of my winners. It's not easy to find strong stock. So once I get into a strong stock, I want to give this the benefit of the doubt, because we don't, this stock could be, 500 next year. We don't know. So I don't want to sell out of it entirely and say, well, I made 24%. That was great, because I've seen too many stocks go up 24% and then they're up 124%. But once it hit over plus 20%, I said, okay, I'm gonna dial back some here. I'm gonna move up my stop, and then I'm just gonna manage the position from there. But realistically, as long as this stock continues to hold that rising 50-day moving average, then I'm gonna pretty much lean into this on the long side. If it starts to break down below the 50, then I can look at cutting some out of it. As far as initial stops, my initial stop based on the volatility of the stock is anywhere from 10 to 15%. Now, as I said, I'm not always going to hold all stock. I cut a stock today that was down 4% because I wanted to buy another stock, another comparable stock. But my initial stops will start at about 15%. And then over time, as the position starts to work, I'll move those stops up.
Yeah, that was really going to be my next question. What if you have something that's not working out that well for you? Let's just say that, you catch one of these breakouts and all of a sudden it just goes sideways. Yeah. And earlier you said you love to see the moving averages going up. Well, what happens if they all get bunched up and then something breaks out somewhere else? Do you then raise capital in a sense by selling something that's not working as well because something looks a little bit juicier on a setup?
It's very possible. So for example, I got into NVIDIA, and my NVIDIA position, when I got into it, can you see my cursor?
No.
Okay. So the last one I did, you couldn't see the cursor. So if you look at the April 30th, NVIDIA came down to the 20-day moving average. Bottom line is I bought it there. It started about 10% down. But I knew that with NVIDIA, I was going to go down with the ship. So I was either going to get stopped out or I was going to leave the stock alone, because I'd been in NVIDIA before and I made a bunch of money in it. So I knew that this stock has what I consider home run potential. So if it's got home run potential, I'm going to sit there, and if they hit my stop, they hit my stop. But now I got out of a hotel stock today, right? Marriott Hotel, and I was down like 4% in the position. Now, here's the thing. This stock, so I bought it somewhere in here, somewhere in October. It made a new high, and then they took it down. Marriott could do just fine, but I'm not worried that, and I could be wrong, but I'm not worried that Marriott's going to go up, 50 or 60% in the next few months, like I knew NVIDIA could. So I saw a better cyclical idea that was breaking out. So I sold Marriott. I was down like 4%, and I moved it because when Marriott started to break out, you see at the beginning of November when it started to break out?
I do see that.
So that's what I was looking for.
You're talking about where it was sideways and then it started to get up, where the volume started to spike.
Yeah. It broke out at the end of October. So I was in that breakout. And if that stock would keep trending higher, then I would stay with it. But now it's come back down into its base, and I'm going to move on. So I don't hyper trade my stocks. But what I do is I weigh the potential risk versus the reward. And with Marriott started to break out, that's exactly the move that I wanted. But now it started to come back down. So I've cut that position at negative 4%. And I moved into another stock that's breaking out that I think might give me a better, return for my money. But I held Marriott for like a month. And had Marriott stayed with that breakout, I'd still be in the stock. But you can't, the key thing that I try to stress with people, you can't own everything. So what I have to do is I have to weigh, which chart's a stronger chart and where do I think I can make more money.
Yeah. And, I'm not, like I said, I'm not somebody who does a ton of stock trading, but what I look at when I see some of these companies, whether it's a Marriott or maybe an airlines, and I'm not someone who's super familiar with all of them, but do they typically just not have the upside potential that the Teslas and all of these other tech stocks have? So I guess I'm curious, like when you look at a Marriott, and is that part in your thinking that, look at this one essentially is how much really could it go up? I mean, you talk about taking it off at 20% and then like making 50% over 6 months. Do some of these stocks that you look at, these bigger blue chip stocks, do you ever just rule out to say, this stock just doesn't move enough? I don't even want to trade this, even though it's fitting my credentials.
Sometimes yes, but if you look at the Marriott chart, and I'll just quickly see if I can put this line on here. Here's what I found: when stocks break out to new all-time highs, there's literally no telling where they can go, and we saw that with a lot of these stocks recently. But it's not just tech stocks. I mean, if you look at Home Depot, Home Depot is breaking out. But what I found is that when we don't know. I mean, Marriott's a $50 billion stock. We don't know what these travel stocks, could do on any rebound. So when I see a stock break out to a new all-time high like Marriott did, my brain is programmed to say, I know that when stocks make new highs, technically, the upside can be unlimited, technically. So, I've seen, copper stocks, and look at these oil stocks. I bought Devon Energy. So this has been a home run for me. And I shared this on Twitter. I did a blog on it, but I bought Devon Energy at $28. And you say, well, it's just an energy stock. I'm up like 50% in less than 2 months because it broke out to a multi-year high. So 31 was a multi-year, and you see it just took off. So I know that if I buy stocks that are breaking out to new highs every so often, they turn into some pretty big moves. But I generally balance my positions between about 50% is pretty high octane, Tesla, things like that. And then the other 50% is, Devon Energy, steel stocks, things like that, because what I do know is the tech stocks are great when they work, but when they pull back, they all pull back at the same time, and they pull back pretty sharply. If I were a shorter term trader, and I used to trade, much shorter term, it's easier to just cut all your positions, right now, because you can buy them back tomorrow. And if you're a short term trader, when I traded short term, it didn't matter to me. I could sell every single position right now. It wouldn't matter to me. And then if the market picks up tomorrow or the next day, I'll just buy positions back. But because I've got a longer term time frame now, I'm not going to cut, all my positions today and buy them back tomorrow. So that's why I don't run a 100%, high octane, just all tech stocks.
Yeah, man, I got to tell you, it's a commitment to being any trader, of course, but for me, as much more of a shorter term trader, and I consider myself so much longer term than what I used to be. I used to just be in and out for ticks with size, but now that I'm more of an intraday, multi-day swing trader, I feel like that commitment of time in my mind, committing to that, was very challenging for me. No matter how much success I had trading on a short term, when I had to move to just a little bit of a different time frame, I felt that was just such a hard commitment, because in your mind, you want to be flat. The minute I get into any market, all you think about is wanting to be flat. And I'm looking at what you're doing and having that commitment, that just so much goes into your preparation, and you saying, I have to stay committed to this. And this goes back to the consistency and the simplicity of it, because it's really a mental commitment to be in something that long. It seems easier.
It's a lot of volatility, that you need to ride through. So I'm in C, and they were taking C out to the woodshed today. So I got into C off the top of my head So I was in C before. I made good money in 2020, but I bought into it again. But C is a stock, from 300 to 250 in 2 days. 360 to 300, 280 to 200. This is a lot of volatility. Here it's 350 to 300 today. But, I'm holding through all of this volatility, because if you look, for my time frame, this is still a super strong, longer term uptrend in a monster, growth stock that's, they're growing their sales triple digit. They're the Southeast Asia tech stock. But, if I was shorter term, I would not hold through this whatsoever. But because I'm longer term, I'm actually looking, as long as it stays over this 200 day, and right now it's holding 300, I'm looking to add to this position at some point, because I'm long from 260 and change. So I'm going to hold through all this volatility. Look at Tesla. That stock, look at all this volatility that it went through before the big breakout. So I won't hold all stocks through all volatility. But when I get into a stock like C, that in my mind, if you're going to own one tech stock in Southeast Asia, C is by far the true market leader. But I just know that I'm going to be I'm going to be holding through, some of these drawdowns. If I traded shorter term, I would do almost everything differently than I do right now. I would have much bigger positions. I would have much tighter stops. I probably trade, 5 or 6 or 6, maybe I would trade 2 or 3. When I used to swing trade, I would trade maybe 2 or 3 positions, but much bigger size. Yeah. Because it would either work right away, or I would just get out. So, but I don't want to do that. I don't want to stay glued and watch those positions all the time, or, because what my time frame is, I don't want to look at a stock like C and realize I sold it at 50 and then it's 350. So I look for the true market leaders, but I'm looking at larger cap stocks. By the same token, I don't want to sell a stock for a 5% profit and then it goes up 50%. I'm not good with that. I'm not good with looking at all the money I left on the table, and that's why I'm geared longer term.
And this is one of the reasons why I really like having you on the show, because as a futures trader, I think for a lot of us that are doing a longer term portfolio, this is great help. Because this is a lot of prep, and I talked about the time commitment to holding these stocks like this. If it's something you're interested in, you laid out a really clean strategy about how to go after that. A couple more questions today
Sure.
before I let you go.
Yeah.
CC64YT is asking, looking at the overall market being parabolic from COVID lows, I have much difficulty being bullish. It's an issue, I know. How does one deal with this negative bias? And what did we talk about at the beginning today, Larry?
Right.
We talked about it. If you look at chart patterns, you're going into it with a bias. But if you use moving averages, the market's proving something to you. Talk more about that a little bit for that question.
And that's a great question. And that's why I like to use moving averages, because what I know, I really like to live, for the most part, above the rising 50-day moving average. But if a market or stock is breaking out or it's holding above that rising 50-day, it doesn't matter what I think. And it doesn't matter what anybody else thinks, because the market's going to do what it's going to do. So we can either do one of two things. If we make a commitment that we want to make money in the market, then we need to learn how to play the game that the market is going to deal on the table. If we want to play our own game, the market doesn't care, and we're probably not going to make any money. And I want to make money at this. So it's like playing, blackjack or poker. You have to play the cards that are on the table. I'd like to get pocket aces, but I got a 2 and a 7. So, so what do? So the market's trending higher by any sense of the imagination. This right now, for most time frames, is an uptrend. But the key thing is I want to look at how these stocks are acting. So even if the market starts to get choppy, there's stocks that are breaking out, every single day. Like we looked at Applied Materials. Applied Materials started to break out. It doesn't matter, what the index is doing. This stock is breaking out. So I pay attention to the index, but it's more important what the actual stock charts are doing that I'm holding. Let's say the market goes straight up and all my stocks are going down, right? I need to get out of those stocks. So, people need to try to learn how to turn off their bias if the market is consistently proving that their bias is wrong.
I totally agree with that. I mean, look at me. I talk about my long position right now in the Russell, and look at what that's done. If I go back to look at what that's done, why would I ever want to buy it on a breakout to the upside? But once again, it proved to me, I'm not trading a breakout strategy, but not getting into what I'm looking at today. But if I looked at just a chart from what it's done since COVID, why would I want to be in it, right? But we are where we are. And if there's anything we've learned is that you have to take the market for where we are now and what it could potentially do and just manage your risk, which brings me to the next question from Jim Valentine. He said, Anthony, I got here a little bit late. Did he discuss what he goes into over downside protection? And we did talk about this, but I think it's an important thing. We actually have more questions after this, Larry, so I want to answer this one really quick if you could. Like, what is your process for stop losses and preventing yourself from losing too much?
So my stops start at 10 to 15%, and I generally put 5% into a position. So if I take a 5% position and I've got a 10% stop, if I get stopped out, I lose 0.5% of my equity. So if someone's got $100,000 account, it's a $500 hit. So you're going to eat dinner. You're not going to miss any meals. At a 15% stop, 5% position, I lose 75 basis points. My main goal is I don't want to have any one position, if I'm wrong, cost me more than 1% of my equity. So if somebody's running a $100,000 account, they buy a stock, they get stopped out, it costs them $1,000. It's really no big deal. You can be wrong. You can go through a pretty long down streak at 1% worth of risk, and you'll be okay over the longer term. Now, there's sometimes I'll go a little bit bigger in ETFs, based on what the market's doing. But, 10 to 15% is my initial stop. I don't want to lose more than 1% of my equity if I get stopped out. And very often, like I said, I'll cut positions above that stop and I'll move the stops up. So the perfect scenario for me is like Snowflake, where, if I look at my starting capital, I've already booked gains and I've moved up my stop to break even. So now this is pretty much a guaranteed winning trade. It's like a poker table. If you sit there and you've got the hand, how smart, if you have, double aces, and you play like you've got pocket aces, then everyone else at the table knows and they fold, and you misplayed the hand. So when you have a strong hand, you want to play it semi-weak, and that's how you extract the most amount of money from the table. So with these positions, I know I've got a winner in Snowflake. I've already taken profits, and I've raised my stop up to break even. Now the question is, can I manage this trade the right way to really make a lot of money from it? And that's what I'm working on.
Last question we're going to take from everybody out there today, and this is from Kapil Sood. When holding your positions for a long term, do you also use any option strategies to make money while holding the stock?
I don't, and that's a good question. And I know a lot of people will write covered calls and things like that, or I guess that's the simplest way to generate more income. But I don't, and I used to do a lot of stuff, and what I found is that the less moving parts I have, the better. So let's say you wrote a covered call on Tesla at 600. And then they called it, you made whatever 5 points, and then they called the stock away from you. Then it's 1250. So I just found if I want to hold the stock, I hold the stock. Nothing wrong with writing covered calls and all that, but it's more than I want to do, and often it would take me out of a good position.
LT, thank you so much for joining me today and being generous with your time, answering all these questions. Where could everybody follow up and follow you on Twitter, and give us a website to check out?
Number one, thank you so much, Anthony, for having me on. I always appreciate it, my friend. I talked to my wife. We've been planning to come to Florida for 2 years, and COVID and all this. We're coming down. I know where you live, and we're going out. The dinner is on me. That's number one.
Okay.
Right? My website, bluechipdaily.com. You can go there. If you go on, you can go through a bunch of charts and see videos and things like that. And then on Twitter, I'm at LMT978, and I think you put that in your in the notes or what have you. But yeah, the website or on Twitter, and I'm pretty active on Twitter, and I try to answer the questions as quick as I can.
Yeah, I know you do. You're very generous with your time, and I look forward to that dinner, and looking forward to meeting you in person, meeting your better half in person, and just having a good time. It's always so much fun when I get a chance to meet the people that I've talked with for so many years. I mean, you and I think we did our first podcast. It's probably about over 4 years ago, 4 or 5 years ago.
Yeah,
crazy.
It seems like it was yesterday.
I know. I mean, it was 4 or 5 years ago. I was looking at some of the podcasts I did in the first few years I started to do this. I mean, it's going to be my 8th year with the podcast, and it's grown because of having great people like you on. And like I said, you've really helped me. And I know a lot of the futures traders out there, they even were putting comments out there on Twitter talking about how you've helped them. And it's just great to hear that longer term perspective, because as futures traders, we're tight in our own little box. And I love doing these podcasts like this to get us to expand our thinking and to be able to take our investments. Because I look at what you do, and I know it's trading, but I look at it, and for me, is a lot of it like what I should be doing with my investment accounts and things like that. And like I said, you lay out such a simple and clean process. I really appreciate you taking the time to speak with me today. And I hope everybody goes. I put both the links out there for Twitter, on YouTube, and for your website to go to learn more about LT.
Anthony, before you cut me off, number one, thank you for having me on. Listen, you do a phenomenal job. You're the real deal. There's a lot of people on Twitter, and I've been in the market since 1998. And I know, I can tell by listening to people who's been in the trenches, and you post a lot of great things on trader psychology, money management. And listen, we're all traders, whether someone's a day trader, a swing trader, a position trader. We're all out there every day in the markets with real money. So I think we all learn from everyone, and I really appreciate you having me on.
Thank you so much, my friend. I can't wait the next time. We're going to keep it a shorter time frame in between our last one to this one. And
sure.
Maybe hopefully we'll be talking about how our dinner was on the next one.
There you go. I like that idea. That's great.
All right, LT. I'll see you later.
Anthony, have a great one, my friend. Thank you.
All right, everybody. Hope you really enjoyed this podcast as much as I did. If you did, hit that like button on YouTube. If you're listening to this on audio, please leave a 5-star review if you're listening to this on iTunes. All of the Futures Radio Show podcasts are recorded. So if you're watching this on the live stream right now, you can go and find this everywhere where my podcasts are available. You can go to anthonycrudele.com and got a ton of videos and stuff on there as well for you guys. That does it for me this week. Once again, thank you guys so much for joining us, and I will see you next week. See you, everybody. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.